Now, what if this oil glut that everyone's hyping as a bargain for your gas tank is actually a silent alarm screaming that the global economy is about to slam on the brakes and hard? Well, forget those feel-good headlines about lower prices. This billion-barrel surplus isn't about abundance. It's the smoking gun of demand collapse that could torch jobs, shred your savings, and trigger a massive market nosedive. Now, stick around because I'm going to flip your worldview on why this deal is your urgent wake-up call to safeguard your future before it hits right here at home. Now, I want you to picture this. There's a massive flotilla of over 1 billion barrels of oil and it's floating out at sea. This is the largest since the 2020 Saudi-Russia price war amid COVID. But this time, it's different. This one's driven by global weakness and it's been amplified by China's rare earth export curves that's slashing shipments by 10.9% month over month amid, of course, the U.S. tensions. Now, this chain reaction is ripping through supply chains. And if demand continues to tank, what you're going to face is factories. They're going to halt because consumers are tightening their belts and banks, as we already know, are freezing loans. And what that's going to do is it's going to burst that robust labor market. Your job in manufacturing or energy, well, right now it's at risk. Your savings in stocks, vulnerable to crashes as energy giants bleed. And Citigroup is warning that oil could plunge to $50 a barrel and would force battered energy firms who've already axed thousands of employees to cut even more. And this ripple starts in Texas, it's going to spread nationwide. And much of this excess oil was being soaked up by China. But right now, they're gripped by deflation as factory demand evaporates right alongside their need for oil. And Beijing's rare earth thrall is accelerating global job losses. So right now, even though pump prices might be dipping, with inflation still simmering and holiday retail sales looking grim, those savings just fuel fear, not spending. Now, this glut is a recession trap, so hang tight. I'm going to unpack the data, the charts, and how the U.S.-China war pours gasoline on the fire, plus it hits your costs. By the end, I'm going to give you a blueprint exactly how to turn this fiasco of deflation into dollars in your pocket. Now let's dive in because oil is flashing recession red flags. Global inventories right now are sitting at record highs. We have Brent crude sitting at 5-month lows, right around $61 a barrel. And the IEA, they're forecasting a 4 million barrel glut in 2026. That's nearly 4% of world demand. So if you think about it, this isn't oversupplied bliss. It's a deflationary trap that rate cuts aren't going to fix. Because right now demand is cratering because factories worldwide are getting shuttered, they're cutting back production, and they're getting hammered. Now let's turn to China, who's caught in their deflationary trap, as we find out the Chinese export boom can't stop their economy slowdown. Because right now in China, retail sales are forecast to have expanded 3% in September and industrial output to climb only a mere 5%. And this is the weakest outcome this year for both. So I want you to think, without robust retail sales, manufacturing stays mired in deflation. For China, it's been there for years. What this is going to do is trigger further layoffs and endless price wars and price cuts. So what you'd be thinking here, where retail sales lead, factories follow. And well, here's the evidence. Let's take a look at this chart of advanced retail sales versus industrial production. That's shown in red. And you can see where advanced retail sales go, well, industrial production falls to the downside. Now, mostly this happens going into recessions, but you can also note, looking around 2015 to 2016 as a global economy slowed, we saw the same relationship. The problem right now is we're seeing retail sales running at a fairly decent clip, but American consumers are saying, look, we're going to cut back our holiday spending and in a big way. And this is a huge problem for the U.S. economy and the entire global economy. So you start to see what oil is warning about here. It's saying, look, the rest of the world is about to follow China right down that deflationary spiral. At the end of the show, I'm going to show you exactly how to turn this oil glut into real dollars in your pocket. But there's another thing you can do to put money in your pocket, and that is my ultimate meta strategy. And we just put out an incredible trade for our subscribers on Monday. Now, what is it? It is a strategy that combines 10 professional trading strategies, now fully integrated with Momentum Timer Pro and CTA Timer Pro. We're targeting a 2 to 15 day hold, optimized at 10 days. We're generating over 150 signals a year with a success success rate over 55. And again, we're fully optimized on a per security basis. Nobody has done that. Now, to get in on this trade and more trades like it, all you have to do is grab those links in the description below. Use a coupon code for your free 30-day trial. Stay tuned to the end of the show for more information. And now let's take a look at this chart of West Texas Intermediate crude oil prices, that's shown in blue, against industrial production in red. And I want you to see the very clear relationship that demand drops precedes slowdowns each and every time. So you can see going back into the dot-com bubble, what happened? Industrial production was already headed down, then oil prices accelerated that downturn. You see the same thing happening going to the global financial crisis, right around 2015 to 2016 when the global economy was slowing. It was happening going into the pandemic, and now you can see very clearly the crude oil prices is suggesting that deflation that's being stuck right inside China's factories, well, it's telling us that the U.S. is next. And the International Monetary Fund nails it in their outlook, as they said, rebalancing toward household consumption, including through fiscal measures with greater focus on social spending in the property sector. And scaling back on industrial policies would reduce external surpluses and alleviate domestic deflationary pressures. Now let me translate this, because what the IMF is saying right now is we need fiscal stimulus and we need a lot of it. But there's a problem. Government debt is sky high. Now, I've been warning about this for years, that governments have continued to spend like crazy. The problem is when the global economy turns down, we need governments to borrow money and spend it into the economy to turn things around. And right now, there's not one government in this planet that is in position to do that. China may be, but their problem is they can't stoke enough demand because they're so reliant on the global consumer. As China rare earth product exports shrink as U.S. frictions flare, the shipments of materials used in electric vehicles, weapons, and high-tech manufacturing stood at over 6,500 tons. That compared to over 7,300 tons back in August. My friends, it's a 10.9% drop. So what this is signaling is that factories that are already starving for materials, well, they are not going to have those rare earths. So you're going to see factories that produce EVs, weapons, and technology, well, they're all going to be throttled back. No rare earths, global production is going to halt. And that's exactly what oil's plunge is telling us right now. And that's why it's so critical, because what it leads to is rising unemployment. Now, it doesn't happen every time, but I want you to see this chart of WTI versus the unemployment rate. Now, the unemployment rate shown in red, what you can see is periods where oil is crashing. There you can see in blue. What happens? It exacerbates the situation in the labor market and sends the unemployment rate rising even further. And you can see that happens throughout every recession. So what you're seeing in oil prices right now is this hope that the unemployment rate was going to peak and roll over. Not likely to happen. What it's suggesting is that the U.S. is headed right into deflation, right behind China. And again, if you're going to look for the Fed to solve it, rate cuts don't fix this. Now, right now, markets are watching that plan sit down between President Xi Jinping and Donald Trump, who are meeting in South Korea next week, because if this trade war doesn't de-escalate, look for oil prices to plunge and the global economy go right along with it. Now, if there is de-escalation, I'm going to tell you why I think there is absolutely going to be. You can see a tradable bottom in oil. You're going to see a rally here, but don't look for it to go back anywhere near its recent highs. Because Germany right now is already looking for a coordinated response from EU members if China doesn't back down. Now, it's too soon to assess the impact of China's latest curbs, but while it's too early to assess the impact, in a matter of months, it's going to crush their contracting manufacturing sector that's already been contracting for about 3 years. It's going to lead to more slowdowns and more layoffs. So, enter Australia as a potential hero here? Well, Australia Prime Minister is set to meet with Trump and talk about rare earths. But replacing China, it's not going to be easy because there's no quick fix. Now, I want you to understand what's going on here, because right now, Australia mines just about 5, maybe upwards of 7% globally of all rare earths. Compare that to China. They mine 70%. But the competitive advantage China has is they process about 90% of global earths. Nobody can touch them. You're talking, they have total dominance over that. Now, there's some problems for Australia. They've got strict environmental regulations, including protections against radioactive waste from rare earth processing. Now, see, China, they don't have that. You've got to build processing hubs, and that would take billions of dollars of investment, not to mention time. And they need additional infrastructure. But here's the other issue. China subsidizes their rare earths, and that keeps their economies at scale high. The issue for Australia, their output is already 2 to 3 times that. It's only going to be more expensive than China. It's going to drive further inflation. How about the timeline? Well, you could triple their output maybe in a couple of years, but a full catch up to China, you're talking over a decade, and maybe that's a best case scenario. So I want you to think about what oil is signaling. If this mess of deflation hits right here at home, you're looking at potential around 500,000 U.S. job cuts. Talk about the worst thing our economy could experience right now, and it would be centered all around the energy sector and manufacturing. You're going to see pricier gadgets because we have a shortage of rare earth. That means prices go up, inflation stays persistent, Fed doesn't want to cut. And stock volatility? Well, if you see energy prices crash, it means the stock market isn't far from it. You're looking at minimally a contraction here, maybe an all-out bear market. But here's the twist. This chaos just isn't doom. It's your contrarian edge to profit before the masses catch on. And I promise you, they will. Now, you want to look to rotate out of your energy stocks to deflation trades. And what's the biggest deflation trade? I know it's treasuries. A lot of you don't like that. But remember, when deflation hits, interest rates go down, not up. Now, in the short term, you want to be watching these trade talks. It's going to be critical because if there is de-escalation here, and I'm going to give you a hint, they both know what's at stake. Trump realizes if he don't get those rare earths, U.S. manufacturing is going down. And China realizes if we don't give the world rare earths, everyone's going to boycott us, and we're going down. So look for them to strike some sort of deal. If that happens, you're going to see energy stocks, oil prices likely rally here, potential short-term trade for you, but keep those stop losses tight. You want to look to sell the upswing because what oil is telling us, it's not just a supply issue. It's a warning about the global economy that we're all headed into deflation. Now, stocks usually come crashing down when that happens, but now you know how to turn this oversupply in oil into real dollars in your pocket. But something else that could put real dollars in your pocket, that is my ultimate meta strategy. It is possibly the best trading system out there on the markets right now. And I want you to understand because we have fully optimized this on a per security basis. And I want you to see just the difference between an optimized strategy and an unoptimized strategy. Let's first take a look at the meta strategy here. It is optimized, and look at this back test on SPY over 2 years. Total return 71%, beating buy and hold. How about the win rate? See, it's 66.7% on 69 trades. Those are staggering numbers. Max drawdown right around 7.5%. Now let's compare this to my buddy Jay Bravo's popular Bravo 9 strategy, completely unoptimized. Problem is, he says you can't use it on its own because it doesn't work on its own. And here's why. You got total return around 51% missing buy and hold, a win rate of a mere 51% on half the number of trades, and you've got the same drawdown. And that's why he tells people, look, you can't use it on your own. You got to sit in front of the computer and look at charts and do all these things. With my strategy, you don't have to do that. Now, how do you get the ultimate meta strategy? Because we just put out an amazing trade for our subscribers on Monday. Well, you've got to sign up for one of my reports. Now, the first one, this is our flagship. This is called CTA Timer Pro, and we have optimized the machine positioning signals. And when this thing hits, it hits big, because what we look to do is position our subscribers ahead of a big machine buying signal and then get them out before the machines sell. But maybe you like to trade those technical indicators like the RSI, the MACD, and you like to put the trend in there too. Well, we have done that and fully optimized. It's called Momentum Timer Pro. We look at the broad equity, bond, currency, commodity markets just like we do with CTA Timer Pro. But again, we overlay the trend with those technical indicators, and again, completely optimized. Now, to get the ultimate meta strategy trades, you got to sign up for one of my reports. And here's a great thing. You get all of the signals from that report. Plus, you get my opinion on the best trades. We give you full risk control levels, a tracking of all our open trades and returns, a weekly update. And here's the best part. Whether you're trading the Bravo 9 or something else, maybe you're just new to trading, we're going to give you 30 days to try out our report. The reason we do that, we're so confident that you're going to make more money trading our report than anything else. We want your first 30 days to be on me. All you have to do is grab those links in the description below. Use a coupon code for your free 30-day trial. With that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.